and credits. To understand how debits and credits work, you need to know the normal balances of accounts. Assets, drawings, expenses, and contra revenue accounts are debit balance accounts. Contra assets, liabilities, capital, and revenue are credit balance accounts. We'll deal with contra assets and contra revenues in another chapter. However, you need to understand the normal balances of those accounts so you know how to use those accounts in your journal entries. When we're looking at the T accounts, all T accounts are set up the same way. You have a debit column and a credit column. Debits on the left, credits on the right. But depending on the type of account, depends on how you use the T account for them. So for assets, drawing, and expenses, debits will increase, credits will decrease. So if you have an asset and you want to increase the asset, say cash, you received cash, you're going to debit cash. If you are using cash to pay for something, then you will credit cash. Drawing, when an owner takes a draw out of the account, you increase the draw with a debit, you would decrease with a credit. And expenses, when we incur expenses such as automobile expenses, rent expense, supplies expense, utilities, any type of expense, we're going to debit those accounts to increase them, and we will credit to decrease them. It's just the opposite with liabilities, capital, and revenue. Liabilities are increased with a credit. So if we purchase something on account, and we're going to use accounts payable, we'll credit accounts payable. Capital, when the owner makes an investment, we're always going to credit capital for an investment from an owner. It's the only thing this particular account is used for is for when the owner makes an investment. The revenue is increased with a credit, so anytime we earn revenue, we will credit revenue in the journal entry. Examples of some of these accounts or some of these categories would be assets or cash, accounts receivable, supplies, inventory, buildings, vehicles, equipment, and land. Liabilities, accounts payable, unearned revenue, notes payable. Unearned revenue, this particular account here is designated for when you are given an advanced payment from a customer and you have done no work. For instance, if you go to a lawyer and a lawyer asks you for a retainer, the retainer is considered to be unearned revenue. The lawyer cannot do anything with that money until he actually does work to earn that money from you. Unearned revenue. Notes payable is generally for things like if you buy a vehicle or equipment on account, instead of using accounts payable, you're going to use notes payable. And then we have our owner's equity accounts, capital. Capital increases owner's equity. We have drawing. This is when the owner takes stuff out. That decreases equity. Revenue, and the textbook calls it fees earned. It's revenue. Increases equity, and expenses decrease equity. So those are some examples of the accounts that you're going to be encountering in this chapter and moving forward.